4-year cycle over, or do you think that it will remain?
I lean towards remain, but in a more muted fashion. So that's kind of a wishy-washy answer, but it's been around for so long, I'm going to give it the benefit of the doubt.
What are the data points you look at to identify whether we are near or at market tops?
I'll share a couple that we use to try to identify kind of near-term tops. One is...
What's going on, guys? Today we got a great episode with Matthew Sigel. He is the head of digital assets research at VanEck, and he's also the portfolio manager of the NODE ETF. In this conversation, we talk about public equities related to crypto. What are they buying? Where are they interested? And what are some of the risk points that you should be paying attention to? On top of that, we get into the recent staking decision at the government level and what that impact is going to be in the market. And then we finish up talking about the government, the Fed, and what is going to happen with stablecoins. There's a lot to unpack in this conversation. There's a lot of stuff that you've never heard before. So make sure you watch the entire thing. Here's my latest conversation with Matthew Sigel. All right, Matt, I thought a great place to start the conversation is everyone knows that you can go and you can buy Bitcoin or the underlying crypto assets themselves, kind of spot market. There's obviously a lot of derivatives and things that people can do. You're very focused on buying public equities that are related to crypto, whether it's Bitcoin or other cryptocurrencies. You have the NODE ETF. NODE is the ticker. And what I find interesting is this launched 3.5 months ago or so, and you guys have been destroying a number of the other benchmarks. It's up like 28, 30% or so since inception. Bitcoin's up about half of that. So you've doubled the Bitcoin return. And Mag 7, S&P, like any of these benchmarks, you guys are doing very well. Help me understand, when you think of the portfolio construction, like public equities related to crypto, I would think you put Coinbase and, like crypto companies. But when I look through the list, that's not what you guys have in this ETF. So talk me through kind of how you guys are thinking of it.
Yeah, Pomp, thanks for having me. Great to be back here. I think one of the biggest changes with the new administration is around how capital is formed in the space. And previously, a lot of the capital formation came in token land, and you don't need traditional investment banks to do that. That's one of the beauties of crypto. But now with the capital markets so much more open to these strategies, the investment banks are really putting a lot of weight behind bringing equities to market. And you can see that in just the league tables, where year to date, Cantor Fitzgerald has done more investment banking business than Goldman Sachs. Let that sink in, because they've been on the forefront of banking crypto equities. BTIG has done more business than Morgan Stanley. This is really big changes in the market share. And now there's a rush essentially by the investment banks to get involved, and they're willing to underwrite not only the kind of digital asset treasury companies like the one that you are forming, but also anything peripheral to the space. And the banks being willing to hold that paper for 24 hours in the case of an IPO, or maybe for months in the case of one of these pipes or SPACs, is a real vote of confidence to the traditional capital market participants on Wall Street. So we think that's durable, and we think that it's going to be a very wide number of beneficiaries. So we've been running crypto equity strategies for almost 5 years now. And what we noticed is that they are really, really volatile. And the tendency is that at the top of the market, the ones with the most leverage are going up the most and doing the best. Leverage is toxic to Bitcoin, as we learned over the last few cycles. And what that dynamic does is that basically at the top of the market, your crypto equity indices are full of the most leveraged stuff. So when there's a washout, like they're overweight that high leverage, and the drawdowns have been considerable, and the since inception performance of a lot of the crypto equity products have been subpar from my perspective as someone who wants to put a meaningful amount of my own money in products that are Bitcoin aligned. So what we aim to do with On-Chain Economy ETF, and thanks for calling out the performance. I just want to be clear that I think those numbers are correct through August 14th or something yesterday, and but the past is no guarantee of the future, and we're trying our best to manage this portfolio according to this guidelines, but we might be wrong. We might be lied to. You never know. So investing is risky. So not financial advice, but what we're trying to do is take a very wide approach to the space. Any company that has articulated a strategy to make money from the on-chain economy, whether that's as a dealer of digital assets like Coinbase or Bullish, who just came to market, but also whether they're a provider of infrastructure into the space. And given Bitcoin dominance still here up around 65%, some of the biggest infrastructure providers are selling electricity, electrical equipment, other kind of industrial infrastructure. And it's becoming meaningful to the EPS growth. We think it's becoming meaningful to the multiple. They're increasingly calling out the tailwind from Bitcoin mining. I'm referring to that kind of energy and utilities slug. But then you also have this whole class of kind of what I'd call fintech e-commerce names that overlap with some of the Mag 7 in the US, but they're focused on LATAM or they're focused in Asia. And some of those companies are starting to adopt stablecoins, significantly and calling it out as cost savings. So anyway, the big picture here is that our investment universe is vast. It's over 150 names that are have articulated a strategy in digital assets. And we're targeting this barbell approach where, yes, we have some of the pure plays. It's roughly a third of the fund is in kind of that pure play crypto equity space. We have the peripherals bucket where we're into that e-commerce, fintech. And then we have the low volatility bucket, which is this kind of utilities, energy, infrastructure component. And that provides a lot of ballast. I'm trying to compound, avoid big drawdowns by being very diversified. I feel like when Bitcoin's, up here near all-time high, being diversified is a good thing. Kind of the rising tide lift all boats. You might not catch the next 10 bagger, but maybe that was really the trade a year ago to look for 10 baggers. And then as we have drawdowns, we'll be able to kind of jettison some of that low vol ballast and turn up the dial on the volatility. So I think what I'm most pleased by is that the outperformance versus Bitcoin since inception has come with lower volatility. So twice the performance at lower volatility. For me, that's a sweet spot. There's no guarantee we can duplicate that, but that's what we're aiming to do.
Let's talk about maybe the things that would be most surprising to people that are in there. So you talked about utilities, these kind of electrical hardware companies, et cetera. But what are some examples of that? And what are they doing? Are they just simply selling to Bitcoin miners, or are there other things that you all are seeing as the intersection point that then pulls them into the universe that you would consider versus a utility company that's doing nothing in kind of the crypto space?
Yeah, sure. So some examples are just utilities that are operating in specific regions where Bitcoin mining is growing. So some examples of that are like Arkansas, Oklahoma. Okay, so you've got Entergy, which is a southeastern utility. Their commercial load growth has been accelerating. I've spoken to several Bitcoin miners who buy electricity from Entergy and say that they have the right people to service the market, and they're eager to service the market, and they're raising their forecasts for load growth, investing in the space. Compared to what you pay for crypto equities, the stock is quite cheap and pays a dividend. So that would be one name. In Oklahoma, there's OGE, which is the Oklahoma local utility. Google announced this week they're going to invest $9 billion in Oklahoma. Stone Ridge just did a deal for Oklahoma assets. So there as well, the underlying EPS growth should be positive, and you can compound a little bit while you wait for an opportunity. Because
what you're seeing there is, and this is no different than I think how a lot of public equity investors think, is you're essentially going through the full vertical integration of the system, right? So you're saying, okay, hey, we know Bitcoin mining, or we know Bitcoin, right? What is part of Bitcoin? Bitcoin mining. Okay, Bitcoin mining should continue to grow if Bitcoin's going to grow and people are going to be investing in this, which they seem to be doing. If we look at that, then where are they getting their hardware? Where are they getting their energy? What are the geographies? You're just kind of working through the stack. And then when you locate geographies that are growing and you locate who's providing the power, you're saying, hey, let's go then evaluate that business. So it's really the Bitcoin or crypto component is almost a overlay to help you identify potential opportunities. And then you're doing a fundamental analysis of the company itself in terms of whether it is, expensive or cheap or fits kind of your strategy.
Yeah. So they won't even go into our universe unless they've called out Bitcoin, blockchain, crypto as some potential driver of their business. Mm-hmm. And then we're aiming for a certain volatility level compared to Bitcoin compared to the S&P 500. And that's how we manage the portfolio construction. So yeah, that whole supply chain, you have companies that are selling industrial equipment into the data center industry. A company like Solaris, SEI, which is an energy company, but they make essentially these generators that are very helpful to co-locate next to a data center when you say want to use it for a mix of Bitcoin mining and AI. So that kind of dual purpose use requires some extra capex to repurpose. And as we've seen, many of the Bitcoin miners are currently pivoting away from being pure play Bitcoin miners to allocate some percentage of their capacity into the AI. So they need equipment to upgrade their data centers to be able to serve that market. We're looking in that space as well.
Interesting. And so when you think through, okay, you've got like kind of the industrial and energy sector. What are maybe some of the other types of businesses that are inside here? You mentioned some of the like crypto, kind of specific businesses. Is it just your normal cast of characters? There's only so many of them available in the public market, or do you guys look at also kind of a unique way of figuring out who falls into that category?
Yeah. So our bias is to own companies because we're bullish on the space, and the more diversified approach we think is going to provide maybe a more pleasant volatility profile for investors. But we do have, a few screens to help us determine position sizing. And one of them is simply the leverage that the business has compared to its earnings power. And so names like a MicroStrategy, which in a pure play crypto equity index might be 10%, we're down at 3% or less than 3%.
Why?
It's leverage, and the way that these markets work, they're super reflexive. The indexes get overweight the most leverage names at the top of the market, and that's where your biggest risks can materialize. So, we saw it last cycle with all the tech companies that went bankrupt when they turned into Bitcoin banks, essentially. I think this cycle is going to be different because there's a bit more professionalism around how the leverage is being generated. But with a bearer asset like Bitcoin, I still believe that it's a volatile asset, more volatile than stocks. And I want to be in the business of compounding, minimizing drawdowns. And one way to do that is to look for strong balance sheets. Is kind of like the investing 101 from how I think about compounding.
Yeah, makes sense. Let's talk about this Japanese utility company. This one I think is kind of I think the company is called TEPCO, and you all have it in the ETF. And I was looking at some of these, and it's up 50%. In the last, couple of weeks or so. Is that Bitcoin and crypto related, or is that just something that Japan woke up and was like, hey, we need more electricity because of AI, or what's going on there?
I think last time I was here, I told you the story of when I was living in Japan during the earthquake and tsunami and working for Cathie Wood during those days. And we were, we had a lot of nuclear exposure in the middle of a nuclear meltdown. So I'm pretty familiar with the country, the equities, and the nuclear kind of value chain. And there had been stories in the last couple of years that TEPCO made an investment in a company that's mining Bitcoin, this company AgileX. It's really hard to get information from them about it. There's not too much in the media, but that story's out there. And then I saw that EDF, the French nuclear giant, they've also started to do a little bit of Bitcoin mining. Marathon just bought their data center business, 3/4 of it last week. And there's a new proposal in the French parliament to formalize those Bitcoin mining efforts, right? It can be a way to pay down the debt. They've got all this spare electricity that they used to export to Germany. Japan also has some folks of parliament who are talking about amping up the Bitcoin mining. And then the nuclear restart story is starting to heat up in Japan. And I looked at this stock that used to be $30 billion market cap. It's at 6. There's no analyst coverage. They're turning on their nukes. They still don't pay a dividend, right? So there's a lot of risk here. But it looked really cheap. And so combined with the heightened acceptance in France, that whiff of like, maybe we're going to do this. I thought, if that comes to Japan, that could be a big deal for TEPCO, but even without it, the risk reward is really attractive. So, we tweeted at the company to try to get them to talk a little bit more about their Bitcoin mining. I think that would help the multiple a lot, but there's a fundamental story there. There is some Bitcoin integration. If it got bigger, the stock could really rocket. So that's an example where we have some utilities and energy expertise in-house. We have a natural resources strategies. We've got an analyst. All he does is utilities. So he and I talk a lot about, which ones make sense. And we collaborated on that one. So far, it's been working.
Today's episode is brought to you by Figure. They're the largest non-bank mortgage lender in the United States with over $15 billion unlocked on their lending platform. They've just lowered rates on their Bitcoin and Ethereum-backed loans to 8.91%, improving their already industry-low fixed-rate 50% LTV loans. They keep building as well, being the only major CBL player to launch decentralized MPC custody to protect against single entry failure, and they just removed interest deferral fees entirely so you can let Bitcoin price appreciation pay for your loan over time. What is MPC decentralized custody? It's a Bitcoin or ETH on-chain wallet with multiple key shards to protect you from single entity custody failure. You can always see your crypto ownership in a segregated wallet and verify your collateral hasn't moved. Whether you're funding a major purchase like a down payment on a home, investing in new opportunities, or even buying more Bitcoin, Figure makes it straightforward and transparent. Visit their app or click my link below to take out a Bitcoin-backed loan with Figure today. We're talking about a lot of positive things, and there's a lot of good things. But you guys also, I think, are not just like Luddite bulls. Bitcoin's going to $1 million tomorrow. Everything's going to go up forever. You talked a little bit about the leverage that you guys look at and how that may actually reduce the position sizing. One of the other things that I've seen that I'm fascinated by is you guys were critiquing some of the crypto companies, some of the Bitcoin miners for their compensation structures. And one of the things I think in Bitcoin and the broader crypto ecosystem for a long time is it was kind of unsophisticated, not in a negative, way, but just you have a lot of people who are builders, they're entrepreneurs, and the sophisticated traditional finance folks who have the rigorous analysis and are used to doing this and have kind of the reps and the skills and the expertise of analyzing from the outside, which I think in traditional finance holds a lot of companies accountable. They weren't paying attention to this stuff. That's starting to change now. And I think you see companies acknowledging that. They're excited by it. They want these people to, help them build a better company, give them access to capital. You mentioned the banks holding some of the paper, all that kind of stuff. You guys pointed out, though, wait, hold on a second. Some of the compensation structures here may actually be off. Talk through, what you guys noticed, why these companies, and then what your suggestion was.
Sure. So VanEck, we just celebrated our 70th birthday. So we've been around a long time, and Jan VanEck, CEO, takes a very engaged approach on governance. So both the VanEck firm, which, although it's family owned, has an extremely professional board structure and management team, but also with how we approach our external investments. And via our ETFs, we're pretty large shareholders in companies where we don't necessarily have a PM who is making the investment decisions. So we do vote our proxies, intentionally. And now we show up as some of the top shareholders for the Bitcoin miners and these other companies. And so we wanted to take that same approach. And we noticed in 2021 that the executive comp at the Bitcoin miners was out of whack with, say, the Russell 3000, or even if you looked at like the tech sector specifically, it was too high. And
they were paying themselves too much.
Yeah. They're paying themselves too much. And I think it's exactly what you said, which is mostly retail shareholder base who just didn't really have time to read the corporate filings in a way to uncover that. And there weren't too many people on Twitter talking about it, right?
How much are we talking? Are they paying themselves like a couple $1 million?
No, tens of millions of dollars for the outliers, right?
Okay. Per year.
Yeah. And also, although a lot of it was in stock, the performance criteria were, not very strict relative to peers outside of Bitcoin.
Got it. So maybe if I play devil's advocate, in their defense, the numbers might have been big. There was some performance metrics they had to hit. I think your side is Yeah, but they were kind of foregone conclusions you were going to hit it. So it's not really performance driven as much as, performance driven is supposed to claim to be, kind of a thing that you're doing good for shareholders.
Yeah, you got it. And so things kind of...
we got ourselves a little debate on our hands between, okay, I got it now.
Yeah. So 2022, 2023, there was a bunch of bankruptcies. Like this topic was not front and center, but what we noticed in 2023, 2024 is like the problem has reemerged. And in 2024, to use the most egregious example, the board of Riot paid their named executives like 80% of the increase of the value of the stock that year went to the executives, essentially.
And unpack this in terms of, let's just say stock's worth $100 at the start of the year, it goes to 180, right? It goes to 200. You're saying that $80 of that increase went to executives. And how much of that is performance based, where like if you hit a certain share price or something like that, versus it's like, hey, as long as you breathe and show up to work, you're getting, some of the...
it was more the latter, right? Got it. And so this proxy season, shareholders have really started to push back. And
sorry to interrupt, but just one other question is, in those scenarios, did the stock go up a lot or a little? Like 80%, if it only goes up.
Yeah, so like Riot was kind of not a great performer relative to others last year. And it happened to be that the executives had a really chunky chunk of it for 2024. So
got it. So there's
definitely could be some
different
timing.
levers.
Yeah.
Okay,
there could be some timing things. But from any objective measurement, that specific package is egregious from our perspective. So we put out some research.
I should have had the Riot guys here. We could have had a little...
I just met them, so, we had the conversation in person. So we put out...
What was their, just out of curiosity, if you talked with them, what was their defense, or like what was their response?
Their response was that you're right, and we're going to pay ourselves zero next year. So in the earnings report immediately following our report, they said in their call that exec comp was going to come down a lot next year, and then we learned that it'll basically be zero for the named executive comp officer. So it is.
Does that make you happy? Like are you satisfied with that answer? Oh, maybe not.
I think that let's see the whole package, right?
Okay.
See what all the peers do. Yeah, the details matter. But I think looking at kind of your social media on Open Door and
I'm nice. I'm not. I haven't critiqued anyone.
The point is like if you identify something that you think is a better way to do things and you point it out, like people are going to notice.
Let's talk about the Open Door thing for a second. What I find so fascinating about it is, Eric Jackson. I know him. He's been tweeting about Open Door a lot. And I think at first when people saw like there's some crazy price target or whatever, you're like, is this real? I talked with him. I understood where he was coming from, and I understood what the assumptions were. And whether I agree or don't agree, or maybe I think it can get halfway there, whatever the thing is, it was just like, there's logic here. Right. I think was like the first checkbox of like, all right, this isn't somebody who's just like picking a random number out of a hat. Like, okay, let me pay attention more. Let me go figure out, do I think that $82 is real or some other number? And as I started to do that work, that's when I saw a lot of retail start paying attention. And so, frankly, when I bought the stock and publicly came out and said I bought that stock, first of all, I should say like it was kind of a starter position, right? It wasn't like I put 50% of my portfolio in or anything like that. I don't own 5% of the company, so I had to disclose or, anything to that degree. But it was this combination of like, okay, you've got this like iBuying, artificial intelligence, almost like market making business that should be valuable if they can build the right product. You've got interest rate cuts that likely are coming, which should be a boom for housing and transaction volumes and things like that. But probably the thing that got me the most interested was this like idea of like retail activism, where you had a lot of eyeballs now looking at a company saying collectively, how do we improve this? And some people are focused on the product. Some people are focused on, unit economics. Some people are focused on management. Some people are focused on the board. Some people are focused on the market opportunity. Some people, frankly, are just yelling and screaming because they are bored. And some people are saying, hey, we got to do more press. And it's like the hive mind, right? Like the power of the crowd, which I think that what you're describing in some of these Bitcoin miners, like you're one participant. Yeah, you guys are a huge firm, but you guys are one voice of many who is looking at a company saying, how do we improve this? And so the power of that becomes very interesting. Now, hopefully, I think when people look at the way that I approach that situation and continuing to do, I have taken the approach of like, I'm not here to critique any one person until I've spoken with them. Now, if I talk to someone and I'm like, okay, you're not fit for a job or you're not doing a good job or whatever. Like that's a different story. But I think that I try to always give people the benefit of the doubt and like give them a fair shake and say, hey, until I talk to you, I don't really have a strong opinion. I can look at the body of the work, but stocks go up and down for a lot of reasons.
Yeah.
Right?
One thing I take away from your story is the old adage, invest, then investigate, which is that if you're going to be an engaged investor and you have an idea and you think you're early, like timing really matters in this space. Put a little down, monitor the situation. You might come up with a better idea of how things can improve, and the CEO may quit a couple of weeks later, and the stock will be up 50%.
You know what's funny? So, there's a reporter that called me this week. I'm not going to say who it is, and immediately my take with the reporters is off the record. Right? I'm not whatever. And I said, Stanley Druckenmiller's got this famous quote, buy and then research, right?
Invest and investigate.
Yeah. And again, starter position. But what I found so fascinating about it was as I started to talk to people, as I started to do this, like the power of the crowd is very real. Now, to your point, that stock, I'm going to get the number, it's not perfect, but it's up like 60 or 70% in like 5 days. Right? It was, I think a couple of days ago, it was the 5th most traded stock in the world, or at least in the US market. Then it was the 3rd most traded stock. So like there's a tension, right? And what I find very interesting about it is the CEO did step down, right? I was supposed to interview her. That's not going to happen anymore. I don't think we're going to do a post-game interview, right? So you kind of sort of look at this.
Maybe a job interview.
Right? Well, you look at it and you're just like, okay, look at the difference in scenarios. The miners that you guys were critiquing came in and had a conversation with you. Like they should get credit for saying somebody is critiquing us. Let's go talk to them. Because there's a lot of companies, frankly, that especially outside of maybe like the digital world economy type stuff, they're just like, we're going to take our money. Here's a digital middle finger, like see you later, right? They come and talk to you. And it sounds like they're trying to make it right or improve it or, whatever. And so I do think like there is something about, executives who understand this like dynamic digital native world. And most of the miners, they go on podcasts, they tweet, they they're engaged, they understand the power of the community. I think in public markets generally though, most of the executives are not like that, right? They're kind of very much like, I have a comms team, talk to the comms team. And that's where things go to die, right? So you guys in a weird way are a great fit for these types of businesses because you have a voice, you guys do the research, you do the work. When you say things positive or negative, you're talking to a audience that wants to hear from you.
Yeah, I think it goes back to the beginning of our conversation. What's really changed since the new administration came in is that all of the big Wall Street banks want to get involved with these stocks. It was Morgan Stanley bringing Riot around, right? Mm-hmm. So it was JP Morgan who brought Bullish public this week. So these are high quality research analysts and salespeople who are engaging with sophisticated clients or who are, finicky about little things like executive comp, and everyone's going to come to what I think is a better governance solution. That's good for the space. That's why there's going to be so many tailwinds behind this crypto equities space from my perspective.
Yeah, I mean, that makes sense. Let's switch gears. You guys also manage a fund that does staking. And what I think is interesting about the whole staking thing is just like it's native revenue. And there's a bunch of questions about that being a security, not a security. I think we've got some clarity there where the SEC is saying this is not a security. How does that decision change what is going to happen with staking, both in what I'd consider individuals' participation, private funds, and then now we're starting to see these public companies go after, every altcoin ever created and say we're going to do a digital asset treasury for, XYZ coin. What is the big impact of this staking decision? Today's episode is brought to you by Citizenship. If you're a Bitcoiner thinking about global mobility and securing a true plan B, listen up. Portugal is one of the most attractive golden visa programs in the world, and Citizenship has built the ideal pathway to get you there. They're behind the first Bitcoin ecosystem golden visa fund. It's a private equity fund that purchases Bitcoin via a local company. That gives you exposure to Bitcoin while qualifying you for the golden visa and citizenship in just 5 years. Plus, here's what makes this a no-brainer. Citizenship has the lowest fee structure of any golden visa fund in Portugal. And because their team handles everything in-house, you skip the usual friction and bloated fundraising costs of other funds. So if you're serious about sovereign flexibility, now's the moment to act. Go to bitisonship.com/pomp and book a free strategy call with their team. Again, that's bitisonship.com/pomp. Go check them out today.
Yeah. I think one of the most interesting things about the upcoming, cross our fingers Solana ETFs, which I think hopeful that are going to be in the market in the fall, is that we're working to launch them with both staking and with in-kind creation and redemption, so that the market makers who make shares of these ETFs can accept, say, Solana to help us create shares of the Solana ETF. And that will bring down friction a lot in the space when dealing with the ETFs, but it's going to also really professionalize the staking operations. So we're going through, some due diligence now on how we're going to handle staking the coins in some of these ETFs. And it's quite a high hurdle to get kind of everyone across the organization on board with these counterparties. And the regulator is also going to be seeing, of course, who we choose. So things like, SOC certifications, like that type of stuff matters again, maybe even a US validator set. So 3 years ago, in a different administration, we had clients and we also thought that it was less risky to have the validator set of your staked coins be offshore. Now it's maybe 180. There may be some benefits to doing it onshore. So I don't think there's any, huge change in how important staking is. I personally think that a lot of these altcoins have very high inflation rates, and you're getting diluted constantly as an investor without even realizing it, unless you lock up your assets and stake them and earn that APY to at least keep your ownership share of the network flat.
But even that's a crazy idea, right? That you're getting yield, but it's only able to generate enough yield to cover the inflation. Like, one of the things that recently came out that I thought was pretty fascinating, since 1971, the US dollar has debased at 4% a year for 50 plus years. So if you're holding treasuries today, you're basically flat on that annualized thing. Now, some will argue it actually has accelerated in recent years. And so therefore, maybe you're actually on a real return basis negative by holding treasuries. Now,
yeah, I would wonder about the reinvestment assumptions of that, right?
Well,
fair enough.
Whether that is true or not, I think that this idea of, let's say you're staking ETH, Solana, I'm just going on the line. If you are only getting enough yield to cover the dilution of the network, one, the people who aren't getting yield, they're getting screwed, right? But two is you're almost being sold this yield story that isn't actually like true, like your real return is like flat, right?
There's a couple of projects like ETH and Sol where when the blockchain activity is strong, you actually are earning a positive yield, right? And that's what makes ETH and Sol kind of stick out in terms of what type of position size I can justify. The fact that what you say is truth for the majority of coins just speaks to how early things are. Like there's no mass adoption. Mm-hmm. The fees on some of these other blockchains are kind of de minimis. The pass-through mechanism to the token holder is not fully mature. So you're really buying venture type investments. They just happen to be very liquid in token form.
Mm-hmm. Yeah, it's interesting. What about in the things that you guys are building? I think that's another aspect that people don't quite give VanEck and the team enough credit for. Is Agora is one of the stable coins. You all have been building other things as well. Talk through maybe kind of like what the philosophy is around building, and then what's some of the progress on these things.
Yeah, I think our observation on the space is that crypto blockchain, it's a participatory technology. Like the whole point of self-custody is that you're actually touching the software that interacts with your coins. And so if you're not really building something and experimenting a little bit, you probably are not going to understand the space very well. So we have Agora, which is a US dollar stablecoin where VanEck is the asset manager behind the reserves there. And it's Nick VanEck who's operating the company and is doing a B2B approach and being quite aggressive in sharing that underlying revenue back to the partners. And if you look at Circle results and the secondary share sale this week and what they're guiding to, it is that those types of kind of marketing and incentive costs are going to rise. And so we're just going to take a very long-term approach and be a leader on price from the beginning and try to partner with some attractive distributors. I think that, Nick, if I've got that right, I think I have that right.
Do we know what the percentage is that people are giving to the partners? Is that public information or no?
It's not public, but you'll start to see it in the
companies
retail, because those companies will then pass it along to retail, right? So the same way that you earn 4% on Coinbase APY as a retail customer, you'll see that across a number of platforms. Another, just experiment that we've been building is a collectibles platform called Segment, which is kind of Web3 oriented around fractionalizing collectibles and acting as a marketplace for the greater liquidity that has resulted. And I think one of the interesting things about that market is it turns out that actually holding the thing is really important, like the actual warehouse is super important. And it's going to be interesting to watch the kind of real world activity that creates. There's some very sophisticated warehouses that are getting built around storing wine and whiskey and all that stuff, with an idea that the tokenization will make the financial aspects of the asset higher velocity, but you better be damn sure that the whiskey hasn't literally moved a centimeter from where it was sitting, and there'll be sensors that capture all that. So that's been an interesting experiment as well.
And then what are the areas that maybe everyone else is excited about, but you're like, hey, fellas, be careful. Like, where is the risks? One of the risks that I hear people talk about are these treasury companies. I don't know if you guys think those are risky or not risky, but just help us understand if, we get into a bear market at some point in the next 12 months, what are the potholes? What are the landmines that people should be careful of?
Yeah, I think it's the leverage that we talked about. And you can see that kind of in our DAT exposure where we have it, but position size just matters so much when you're dealing with, 80, 90, 100 vol assets. So we've backed a few, but I'd say we're being more cautious than maybe some of our competitors. And in the public equity fund, we're trying to identify some valuation arbitrages. Arbitrage is maybe too strong a word, but there are times I think when valuation will matter with these DATs. I'm not sure it's for the mega caps, but in the kind of small cap arena where management has some levers to pull in terms of maybe buyback authorizations or that can really matter, I think, as a signaling mechanism. So I don't want to say super bearish. I think some number of them will succeed and some number will have an escape velocity type of dynamic like MicroStrategy where they can trade above NAV pretty sustainably. But I think there'll be a long tail that do not. And that could be trapped capital because executives are going to be making millions to have these public companies. If they're trading at 0.8 MNAV, it's going to be hard for them individually to maybe do the right thing by shareholders. So maybe on our next corporate governance, topic, you'll see something from us about that.
Trying to figure out how that exactly works. And let's talk about the government. Government seems pretty bullish on Bitcoin and cryptocurrencies. We saw the Treasury Secretary recently, maybe offhand comment, we're not going to buy, and then very quickly put out the tweet and say, no, we are going to buy just in this budget neutral way. The president seems very excited about this stuff. But also I think even the entire cabinet, you see, Howard Lutnick and many others who are pretty supportive of the industry. Do you pay attention to anything in particular when it comes to Washington, D.C. and kind of some of this regulation stuff?
I'm definitely spending less time on that recently because I feel like the groundwork has been set to catalyze a lot of capital formation in the space, and the investment banking anecdotes are the biggest example of that. So my expectations have been pretty low on federal government acquiring Bitcoin. I actually think Besant said the truth, kind of maybe by mistake, with his comments yesterday about how there won't be a seller. I think it's going to be very hard to acquire Bitcoin in a material size in a budget neutral way without legislation. Just because something is budget neutral doesn't mean it doesn't require legislation, right? Anything material to the finances, even revenue neutral, requires legislation.
Does that mean that the government could nationalize strategy one day?
Well, once,
I've seen people tweet about it, right? They're like, he's just buying it for the government. Now, I'm not saying I believe that,
but that could be in a generation, right? So it's reasonable people wouldn't base their investment philosophy on that.
I don't think
you and I are a little bit out there, so we kind of do, right?
No, I don't think that people are buying and selling that company, Bitcoin, or any of that on that stuff. But I do think that it is an interesting intellectual exercise to go through if you were the government and you wanted to acquire a lot of this because you thought it was going to be very important. Inside the United States, there are a couple of really big piles of Bitcoin, right? Obviously, there's now multiple public companies, but one in particular has got a lot. The ETFs have quite a bit of Bitcoin, right? And I do think that people have fear and anxiety is probably the wrong word, but they're aware of kind of past decisions the government made about 100 years ago or so, right? Where they said, hey, you are going to give us some of those assets. I do think today it would be much harder given the internet and, kind of the way that the relationship of the government and the people work. But I don't think that people are like insane for wondering, how would the United States get a lot of Bitcoin, especially when the Treasury Secretary is saying we're going to get it through confiscation. Now he's talking about criminal, proceedings and things like that. But it's the internet, right? Like people immediately like, oh, you said the word, and they run wild with it.
Yeah, I mean, if Bitcoin were backing, say, 20% of new T-bill issuance, which maybe in a generation, that could be the case, then it will be reasonable to think about the moral hazard associated with if Bitcoin went down 99%, right? But I think that for the world as it is now and likely to be for the next few years, like it's more likely that the government takes its piece by financial repression, higher taxes on Bitcoin mining, royalties or transaction taxes on self-custody transactions,
so
things like that.
Easier things for them to do.
Easier things for them to do.
Yeah.
Yes.
Yeah, there's kind of an interesting way to think about it as well, right?
Yeah.
What about stablecoins? Do you think the government has any relationship or would want a relationship with these stablecoin issuers in terms of, the Fed has quite a bit of power right now. The Treasury has quite a bit of power right now. If you start to have, quote unquote, the production of money, which pseudo production, right? Because technically they still are backed 1-to-1. You are privatizing that to a degree. And so is there anything there that you guys are paying attention to or maybe worried about?
Yeah, maybe the opportunity, I think, or we think, is in the clearing of stablecoin transactions. So the federal government's not going to do one, right? There's even kind of proposed laws out there to make it impossible for CBDC, but individual states likely will. I think Wyoming has been on the front foot about that. And then it's questions is like merchant acceptance. Who's going to accept these things? If you go to Miami with your Wyoming stablecoin, is it going to work, right? So,
you think the states are going to do it for real?
Yeah. It's not very easy, as you know. Right?
No, it's easy, but I just wonder. It's like we're almost going like back in time.
Yeah, I don't know that they're going to be at scale, right? Government rarely does anything super well, so then I don't think everyone's going to be suddenly in Wyoming using Wyoming dollar and things like that. But they're going to experiment, and experiments will have varying successes. But like, who's going to be the interoperability layer for all those stable coins? Because according to federal regulation, they're all going to have pretty similar structures, right?
Well, I was going to say, can they even legally do it? Like, isn't there laws? And I'm out of my depth very quickly when it comes to the currency laws.
No, the state chartered banks will be able to do it. So
they can do it, but it's still backed by US dollars.
Yeah.
Got it. Okay. So it's really, in a weird way, it's like a branded coin that is backed by dollars, not like Wyoming is going to create their own currency that has
US dollar, just you issued from a Wyoming bank, I see. Things like that.
Which technically, I guess right now, like people do issue things from these banks. It's just like their dollars, electronically.
Yes. So we've been in the venture book, VanEck Ventures, where we hired the corporate development team from Circle a couple of years ago, and Wyatt, general partner there, is making a number of investments in maybe who can be the clearinghouse for these next gen kind of stablecoin rails, right? Yeah,
that's interesting. I guess it's somewhat Trumpian for the states to want to put their name on the stablecoin, right? Because to your point earlier, it's like, okay, there was like product market fit was one competition. Then there is going to be an economic competition of who can like give back the most to the clients.
Yep.
And then there's going to be a brand competition, right? And maybe there's other future, kind of competition, vectors, but those feel like the three that are maybe most important, moving forward here.
Yeah, I agree. And then in the public equity space, some of the kind of merchant acquiring businesses or fintechs that kind of like, help retailers accept whatever payments they want. So they're a lot of those guys are starting to add crypto, right? Shopify is kind of a hybrid example of that. And then what coins do they accept and what do they use for the interoperability? Like they actually will have some market power because there's going to be a lot, if this does trickle down to retail / small business, where our base case is it's mostly multinational remittances is probably the biggest use case of stablecoins over the next year or two. But if it does trickle down to this everyday experience, it'll be interesting to see how the merchant acquirers deal with it.
My last questions for you are related to market cycles. 4-year cycle over, or do you think that it will remain?
I lean towards remain, but in a more muted fashion. So that's kind of a wishy-washy answer, but it's been around for so long. I'm going to give it the benefit of the doubt. Next year we have kind of midterms heating up. It's going to be not much happening in terms of progress in Washington. The rate cuts might be kind of well known and already enacted by then. Like, it's too early to say, but I'm definitely on the lookout for a down year at some point here and cycles resuming. But definitely with the ETFs and now the corporate buying, hopefully there's some more counterbalance to that.
What are the data points you look at to identify whether we are near or at market tops? You got any interesting data points?
I'll share a couple that we use to try to identify kind of near-term tops. One is the funding rate. Just how much does it cost to put on a leveraged position? And when that funding rate is over, if it's in double digits for a couple of weeks on a moving average basis, then you're really at the tail end of something. At least that's what the history shows. Doesn't look like that at all. We've had a couple of days here and there where we've had these spikes and then a washout, but there hasn't been that sustained period. And then another thing we look at is the unrealized profit in the blockchain. There's that ratio you can look at. Again, it's elevated, but it's not in kind of scary territory. And then there's the anecdotal stuff like app downloads or, texts from your ex-wife about Ethereum. I got one of those. I was like, okay, this is a little worrying.
They were getting closer and closer, right? Yeah. Since you shared, I'll share one that I've been paying more attention to, which is the 200-week moving average crosses the previous all-time high price point.
Interesting.
And it's been like, now again, could break, but historically like almost perfect.
Gotcha.
Right. So you get kind of a 200-week moving average. And once you cross over, in this case, $69,000, head on a swivel. Right. But, look, one of the things that and I'm asking because I'm personally interested, right, is I think market cycles, if they stay to the 4-year, kind of what we've been seeing, it'd be like October through December. Sometime in that frame would be the top. You'd then get a big correction. People have been around for a while. Okay. Well, if we get a September rate cut, does that extend things? A lot of the digital asset treasury companies are coming to market. Their deals are closing. There's a lot of buying power that starts to hit the market in September, October, November, right? Like there are things that just are external to the normal cycle that could have a potential profound impact, right? Or Bitcoin just is Bitcoin and kind of doesn't care what the world does and, is going to hit a certain level and people are going to say, all right, that's good enough for this cycle, give me my profits and, see you in 2 years at the bottom.
Yeah. I mean, it's really personal calculus on what your time horizon is and kind of what your risk reward appetite is. So hard to kind of answer that question right now, right?
Absolutely. Where can we send people to find you on the internet or find out more about what you guys are doing at VanEck?
Yeah, thanks. You can follow me on X, Matthew_Sigel, or VanEck.com/node. You can check out the fund and all the research that we've written to support our investment thesis.
Amazing. Thank you for coming to do this. It's always fun. And congratulations on all the success. We'll do it again in the future.
Thanks, Pomp.